Hey there, welcome back again for our second installment of the self-directed investment options that are right for you. Now, like I said in the first post, being a self-directed investor can really be lonely, and it's really hard to figure out what kind of investments you want to make and what things you really want to invest in to build your portfolio and build your wealth. Well, as a self-directed investor, it can be really hard to find some of those because we don't really know what's available. So today we're going to talk a little bit more about the other types of investments. Really, we're going to focus on equity investments because equity investments really allow you to build your portfolio and bolster your returns without really having to go into the stock market and get tiny little fractions of a percentage of a company, but really have equity in a company or investment or something like that. So a lot of people understand what equity investments are because of the stock market, because of Wall Street. And when you're buying a stock, obviously that is what you're getting. You're getting a small little share of that company. So you get to share in the profits of the organization. Unfortunately, when it comes to investing in the stock market, you don't ever really get a massive amount of equity because, quite honestly, those companies are so large and so entrenched with their own interests and their own investors that you're never going to be able to break into that as a single self-directed investor. All right, the pension fund managers, the hedge funds, the equity funds, things like that, those people really have significant stakes in those companies, the Warren Buffetts of the world, the Ray Dalios. But you and me as an individual self-directed investor, we can't really make inroads to get a massive amount of equity there, which means we're not really going to get the kinds of returns we might want. So you can invest in various types of companies, and we can talk about investing in private companies as well, things that are not on the publicly traded stock exchanges. And you can do that through common stock or preferred shares. Now, there's a very distinct difference here, and preferred shares mean that those individuals will get paid a certain percentage or a certain return as dictated or indicated on the share itself, the share certificate. And those people will get their money back before any common stockholders do. Okay, so that's a very important thing to understand because a common stock, it gives you maybe ownership and gives you voting rights, whereas preferred shares may not have voting rights. So as a common stockholder, you can maybe vote in board of directors types of things and any sort of vote that the company might bring to its shareholders. When you're a preferred shareholder, you may not have that, but you have first claim to any money that's coming out of the company, especially in the case of a bankruptcy proceeding. All right, private partnerships are another example of how you can actually form a small company using your money. Now, a lot of people go out there and they need to start a business. They're really trying to get off the ground, but they can't go to a bank and they can't get a loan there because they don't have any operating history. So maybe they'll go to friends or family and go to angel investors, kind of like on Shark Tank, and they will form a partnership. And the one person who's trying to start the business will do all the operations, and they'll get everything set up for bringing the product or service to the market and selling it and doing all of that. And then they might need a money partner. Well, the money partner wants to have a significant stake too because they're bringing all the money to fund the operations, to fund the startup and the legal expenses and everything else. So they want to have a certain amount of money as well. They want to have a certain amount of equity in the partnership. So sometimes it can be 50-50 or 60-40, and depending on the type of partnership, you can have an LLC or a corporation. You never want to go with just a general partnership or even a sole proprietorship for legal reasons. If you do end up becoming the investor, then you want to go into it at bare minimum a limited partnership for safety, security purposes, and it really prevents you from being sued as an owner of the business. Or you want to go into an LLC or a corporation. All right, so those are the ways you can do a private partnership. The other thing you can do is a private placement. A private placement is something that, again, a company who's trying to raise money from multiple individuals will have to put together a document that says, look, we are going to be raising money. Here are the terms of how we're going to raise money. Here's how much we expect to pay you. Here's the business. They give you a kind of a mini business plan in there as well as how you're going to get your money out. And this can happen a lot in syndications. So take, for example, a very large apartment complex or office industrial space, and they want to buy this building. Well, it might take $10 million, $20 million to do this, and maybe there's not one investor that wants to buy the whole thing. So the person who's forming this private placement will create the document and share it with all the people that he think might want to invest, generally accredited investors. There are ways for non-accredited investors to invest as well, but there are limitations on that. And they'll use this document to say, look, this is how we're raising money, this is why we're raising money, and this is the return you can expect. However, and they always have to put this in here, so if you ever look at a private placement and it doesn't have this, it has to say, by the way, you could lose everything. All right. So it's kind of a CYA, but it's the Securities and Exchange Commission's and all the individual states' way of making sure that investors are properly protected. Okay. Now, we're not going to go too much into mutual funds because I think people understand that it's a conglomeration of stocks. But there are so many different ways that you can have a mutual fund. You will not find me promoting mutual funds. Okay. It's just not going to happen. When I was a financial planner and helping people understand finance investing and getting out of debt and insurance and all these things, I didn't really understand how everything worked. I'm going to tell you right now, I'm not going to ask somebody to invest in a mutual fund or tell them that's a good place to put their money because I just don't believe in that model. By conglomerating all these stocks and putting them all into one basket doesn't necessarily minimize your risk. In fact, it can actually keep your risk about the same because you're still exposed to the broader market, and it'll increase the cost because of all the fees involved. All right. So, in my opinion, if you're going to invest in funds, look at exchange-traded funds. So they're designed to mimic the market, such as the S&P 500 or the Wilshire 5000, the Russell 2000, those types of things, so that they have a certain number of stocks in there and they're equally weighted or maybe weighted in relation to the exchange itself that they're trying to mimic. And there's a lot less turnover. And because there's a lot less turnover in these funds and they're not buying and selling stocks constantly, it's not going to incur as many fees. And that's really where mutual funds can drag you down. You don't want to be involved in that. Now, the next one on the list is real estate. But real estate's a really big topic, so we're going to save that for another day. For right now, we're just going to go ahead and leave it as it is. And maybe check back tomorrow and we'll go ahead and talk about real estate, okay? Thanks. Jeff Barnes signing off.